Welcome to this special edition of the Screen Podcast. I'm Deputy Editor Louise Tutt, and of course we're here to talk about the deal of the decade, the battle between Netflix and Paramount to buy the great legacy studio Warner Brothers Discovery. It's a saga that's taking on pretty mythical proportions, with many proclaiming the very soul and indeed the very future of the film industry as we know it hangs in the balance. But for this edition, we're keeping it strictly business-focused. Screen's America's editor, Jeremy Kay, has talked to a brilliant mergers and acquisitions expert to understand the cold, hard financial decisions behind each offer for Warner Brothers. It's a really fascinating discussion which sheds some light on questions such as what the Warner Brothers Discovery shareholders will be looking for, who these shareholders actually are, and there's some surprises there actually, the regulatory issues that might come up for either bidder in both the European Union and the UK, and what impact that might have on the shape of the final deal, if any. If, like me, your business insights are mainly derived from watching 4 series of Succession, this illuminating conversation will give you a much deeper understanding of where this deal is poised, where it sits in the pantheon of media M&As, and just what might happen next. Over to Jeremy and Kim.
Hello, I'm Jeremy Kay. I'm Screen's America's editor. And today I'm delighted to be joined by Kim Chua, who is a partner at OC&C Strategy Consultants. And Kim's going to be talking to us a little bit about the ongoing battle for Warner Brothers Discovery. Hi, Kim.
Hi, delighted to be here.
Nice to have you. So just to recap, this is obviously something that's been in the news for a few weeks now. And where we are at the moment is that Warner Brothers and Netflix have agreed to a proposed deal for Netflix to buy only the streaming and studios business of Warner Brothers Discovery for an offer of $27.75 a share, cash and stock, which puts the equity value of that aspect of the company at $72 billion and an enterprise value of $82.7 billion. And then we have the Paramount offer for all of Warner Brothers Discovery for $30 a share, which has an equity value of $77.9 billion and an enterprise value of $108.4 billion, including debt and non-controlling interest. It's all heating up. Paramount CEO David Ellison has gone directly to the shareholders, trying to see if they can approve his deal, they can accept his deal. And we've got Kim here just to talk us over the whole thing. So Kim, first of all, can you just give us an overview about what each company would get were they to succeed?
Well, you outlined it earlier. So Netflix is looking to just take the streaming and the studios part of the business. And that makes sense because Netflix is a streaming business. And for them, it is about strengthening their premium IP. It's really all about the IP for them. Plus, they would love to get their hands on that production capability. For them, the fact that there is a streaming subscriber base is probably less important because they already have over 300 million subscribers worldwide versus Max, which is, I think it's about 50 or 60 million subscribers worldwide. And probably everyone who has Max, I would guess, already has Netflix. So they're not really going to be gaining subscribers. So it's really about the IP, which is really iconic. And whereas if you look at Paramount, it's really much more about gaining scale in streaming. So quite the opposite. Yes, they'll get the amazing IP, and the combined IP between the two of them will really catapult them from being, and the subscriber base from being a number or distant number 4 in streaming. They have about 80 million subscribers. Paramount Plus, and that together with Max, and because they will have the whole business, Discovery Plus, adds an extra 60 million and 20 million. Yes, of course, there'll be overlaps between those bases, but the overall proposition just gets a lot stronger. They have so much more content, and they'll expand their subscriber base just by dint of combining them, plus be in a better position to attract new ones. I was also going to say that the sport element is super interesting. Because between them for Paramount, they'll have NFL, March Madness, they'll have MLB, NHL in the Europe. They'll have Premier League, they'll have the Champions League. Well, because Paramount has just won Champions League rights. And they have Premiership Rugby because people often don't think about it, but they have TNT Sports. So Warner Brothers Discovery owns TNT Sports, which has a big sports portfolio. So they'll end up from, a few weeks ago having nothing in sport to having a really strong premium sports play. And that, as we know, really drives subscribers.
Yeah, it's a lot of land grabs around sports these days, aren't there?
Yes.
And then I want to go into the whole NA aspect of it. I know that's one of your specialties. And as recently as October, Netflix co-CEO Greg Peters, this was before the proposed deal with Warner Brothers Discovery was announced, said, I quote, one should have a reasonable amount of skepticism around big media mergers. They don't have an amazing track record over time. Just talk to us a little bit about the recent history of M&As and what you make of that statement.
I mean, he wasn't wrong to sound skeptical. The track record, I would say, is mixed. And actually, the failures are pretty high profile and well documented. But there are successes, So on the successes side, Disney has done pretty well in this space. So it acquired Pixar, Marvel and Lucasfilm. This was a while ago. So Pixar was in 2006, Marvel was in 2009, Lucasfilm was in 2012. These were relatively smaller acquisitions, so sub 10 billion rather than the numbers of billions that we've been talking about earlier. And it was these were really about IP. So interestingly, it wasn't about subscribers. It was about building a really strong IP base. That said, Disney has recently, or more recently, rather in 2019, acquired 21st Century Fox. That was considered, and if you just look empirically at the evidence, was less compelling. It was a much bigger deal, 71 billion. It did have lots of IP within it, but there was a bidding war, as there is today, with Comcast. And so between the first bid and the amount that they actually paid, there's probably about a 30 or 35% premium. And if you just look at it simply on a share price basis, the share price back in 2019 is higher than it is today. There are many reasons behind that, but it's worth noting. Whereas actually between 2006, when they first did their IP deals in 2019, I think it grew like 5 or 6 times.
Right. So it can work for some and not for others.
Yes. So I was going to then talk about some of the ones that haven't done so well. These will be probably well known. AOL, Time Warner, TNT, and Time Warner. And then actually the Warner Brothers Discovery. So there is a common thread in those mergers which have not done well. There also is, though, the Viacom CBS recombination, which also hasn't done well. So these are all big mergers. There are lots of reasons possibly behind it. I think synergies are easy to write down on paper. They are much harder to realize in practice. This is where integration and strength of integration really matters. There's culture clashes as well to deal with. But also, I suppose, underlying it is not getting too swept away with valuation and making sure that the amount that you're paying can be justified by what you can actually gain from such a deal.
Yeah. Okay. Thanks for that, Kim. And then I just want to talk a little bit about the shareholders. Just talk us through a little bit about what shareholders are looking for from out of this. Are they thinking about their own short-term financial gain? Are they strategic about how the evolving profile of a company might benefit them down the line? How do you see all this?
Well, the shareholders, there are a lot of them, but actually they're not all retail shareholders. Most of them, in fact, 2/3, I'd estimate, of the shareholders in Warner Brothers Discovery are big institutional funds. Think the likes of Vanguard, BlackRock, State Street. And actually, these funds will not only be invested in Warner Brothers Discovery, they'll also undoubtedly have investments in and stock in Netflix. So they'll have to be looking at it in the round, so what drives value or upsides in terms of what they get for Warner Brothers Discovery, but if they own Netflix, are they overpaying? And they'll be looking at also the risk and reward across the entire portfolio. They would look at what value can they actually get from the deal, but they'll also be looking at the certainty of getting that value. So Paramount, the value is certain because it's a fixed amount of cash, which they can then choose to reinvest as they please. Netflix is more complicated because there is some cash, there's some Netflix shares. There's actually the residual value of the cable assets that are left behind that as shareholders, they'll still have a stake in. So it's just less clear what it all amounts to. And there's more uncertainty around that because there's how the Netflix share price does and how the remaining cable business does. Then there's the overall regulatory uncertainty of of the deal going through. Many shareholders might see that Netflix is more risky, and we can talk about why in a little while, because people will probably have heard that regulatory approval seems to be less certain for Netflix than it is for Paramount. And that is, in my assessment, likely to be true.
So given that some of these institutional shareholders own shares in Warner Brothers Discovery and Netflix, does that make the Netflix deal more likely to go through?
That's a really interesting question. I mean, you would expect that Netflix, the board, would have consulted the large institutional shareholders on their deal, given the size of what it is. And so they would be supportive of it. That said, that would have been before there was a counter offer and a hostile bid on the table. So whilst it's probably fair to say that the large shareholders would have been in favor of the deal that was on the table, it isn't necessarily the case that with more on the table from the hostile bid, they would necessarily choose the Netflix deal versus the Paramount deal.
Well, let's move on to the regulation aspect of this. And in the United States, we know that the Department of Justice will be looking into this, and maybe some of the state attorneys general as well. But I really want to focus with you on something I think is of great interest to our listeners, which is the European Union regulation and also the UK. Tell us a little bit about the landscape there and how you think that might play out and what they'll be looking at.
Okay. They are similar with some differences, and rather than going into all the ins and outs, I'll talk about in general how they look at things in commonality and probably more from an EU perspective. Generally, I think for this, there'll be three areas. One, they'll look at streaming market power. And by this, what I mean is, if you're a regulator, you'll be worrying about any one firm gaining too much market power. By this, it means, will that firm have market dominance? Can they change their pricing or set supplier terms or customer terms without worrying about what their competitors or their customers will do in response? There are certain thresholds which trigger an assessment. If you exceed or can be seen to exceed about 30% market share, then that definitely merits regulators having a look at it. 40% market share is often viewed as a strong indicator of potential dominance. I haven't done the maths about exactly what it is, and one of the key things that makes a difference here, and people might argue, is what the market definition is. So is the market definition just streaming, like paid for subscription video on demand? Should it include, for example, YouTube? Would be a big question, I think, that maybe Netflix would say should be in it. Should it include pay TV more generally? So you can imagine that being those arguments being put to the regulators. That said, regardless, if you compare the two, Netflix will be, or is likely to, under some definitions, reach some of those thresholds, whereas Paramount, even with a combination of Max and Discovery Plus, they're much smaller, so it's much less likely that they'll be considered to have market dominance. And if anything, it might be seen as a positive that you have a stronger player to counter the strength of Netflix. The second point, or the second thing that they look at, is vertical foreclosure. And that is that the company in question can use the power that it's got to exert power over content upstream or distribution downstream. So basically, it can set the terms for commissioning content from production companies, or set the terms with pay TV operators through whom they often have distribution partnerships. So again, Netflix already is pretty strong, and so this would strengthen its hand, whereas Paramount plus Warner Brothers Discovery is less strong, so it will be seen as less of an issue there. The third is around media plurality and foreign ownership. So media plurality is just making sure that no single company controls too much of what everyone watches or reads. Largely, people worry about it, particularly in news, which this is less of an issue. These companies have less of a hold around news in Europe, so it's less of an issue for them. Foreign ownership, as it sounds, is about outside foreign companies or state-backed funds gaining influence over strategic media assets. Again, this is not news. However, they'll still probably want to have a look at it. And when I say want to have a look at it, the Paramount bid is reputedly being backed by some sovereign wealth funds in the Middle East, and those might be some of the issues that people would want to examine.
Yeah, even though Paramount has said that regarding those 3 Gulf sovereign wealth funds, they won't have governance. But
Yes.
as you say, that's still something they're going to be looking at, isn't it?
I mean, they'll have to look at that and assure themselves that that isn't the case.
Interesting. Thanks, Kim. And then what about the UK regulators? Might they take a different stance?
Well, in the UK, the CMA, Competition and Markets Authority, they tend to take a more flexible but sometimes tougher stance. They will assess similar things, but they'll look very closely at consumer harm. They'll look at the level of competition in these digital markets. And something more specific to the UK, they might look at whether exclusive control over these big film and TV libraries and these subscriber bases could disadvantage the UK broadcasters, namely BBC and ITV, Channel 4, Sky. So they will look more specifically at the UK market and the impact on the UK market and its customers and consumers, audiences, but largely looking at similar things.
But presumably they see things they don't like. Then I'm wondering what would happen next. I suppose the bidders would just have to come back with a revised proposal. Yes, I mean, these regulators have what can they actually do if they don't like what they see in these bids?
If they don't like what they see, often rather than trying to block something outright, they look at remedies or they suggest remedies of things that they might do in order to allay certain considerations. For example, it might be, well, actually, you might divest of certain assets, for example, or undertakings to behave in a certain way. So that might be a possibility.
Great. Well, there's everything to play for. We'll keep on watching this in the weeks and months ahead with interest. But meanwhile, Kim, we're very grateful to you for your insights. Thank you very much.
You're very welcome. It's been a pleasure. Thank you. And I'm really looking forward to hearing what happens about this. Does feel like an unfolding saga, something that you'd be watching on TV maybe in a couple of years.
Exactly. But who will own the TV? Thanks very much, Kim.
Who would? Who would be making the show?
Thank you.
Very welcome. Thank you.
Thank you, Kim and Jeremy. That was really interesting. And thank you too for listening to this extra edition of the Screen Podcast. Don't forget to subscribe and review us, please, wherever you get your podcasts. And we'll be back next Thursday with our regular episode. Goodbye.